Today, it's a big one. How countries go broke. We're digging into excerpts from Ray Dalio's work.
The material you sent really gets into debt cycles, looks at historical cases.
And even touches on what might be coming next. It's quite a lot.
It is. So our mission here is really to distill Dalio's main arguments for you. Why do countries hit these financial walls?
What are the patterns, the signs?
Exactly. And what does he think about where we are now? We're focusing on the bits that help you make sense of these big economic shifts we're seeing.
And we know you, our listener, you want to learn quickly but properly. You like those aha moments.
But hate being swamped with info.
Yeah, right. So we've structured this to be, hopefully, clear, engaging, maybe even some surprising facts in there.
But without being overwhelming, we want you to get it.
Before we jump in, maybe just a quick word on Dalio, his background.
Sure. I mean, he's been a global macro investor for, over 50 years? He's seen a few cycles.
And he's written some pretty influential stuff before on, economic principles and debt crises.
Right. Books like Principles for Navigating Big Debt Crises, Changing World Order. His framework comes from decades of, actually navigating this stuff, gives his analysis some weight.
Okay, let's get into it. The big debt cycle, in a nutshell. Dalio really focuses on credit, doesn't he?
Oh, absolutely fundamental. Credit is, it's the main fuel for spending in an economy.
And the key thing is, it's easy to create.
Pretty much. It's just an agreement, right, between a borrower and a lender. Doesn't need a government printing press initially.
But that ease is kind of a double-edged sword.
Totally. Short-term, credit boosts spending, earnings, everything looks great.
Feels good.
Yeah. But it's borrowed spending, it creates debt, and that debt eventually needs repaying.
Which means less spending down the line.
Yeah.
Creates that up and down.
Exactly. The short-term boost has a long-term cost attached. It's a cycle.
And Dalio says governments and central banks kind of lean towards creating more credit.
Well, yeah, he argues there's a bias there. It gives the economy that quick lift, which, tends to be popular.
Like an economic sugar rush.
Good analogy, but it doesn't last.
Then he gets into this idea of holding debt, like bonds, becoming less attractive. How does that work?
So, as a country racks up more and more debt, investors start thinking, what if they just print money to pay this back?
Devaluing the debt I hold.
Right. So holding that debt, those bonds, starts to look riskier compared to, say, owning a piece of a productive company or something like gold.
So the debt itself becomes less desirable.
The more there is, potentially, yes. Especially if confidence wavers.
And what about credit rating agencies in all this? Dalio seems skeptical.
He makes a really sharp point. They mostly look at default risk. Will they actually fail to pay?
But not the devaluation risk.
Exactly. They don't really assess the risk that the government might just inflate away the value of the debt you hold. A AAA rating doesn't mean you won't lose purchasing power.
Okay, so let's say a country hits that deleveraging phase. Everyone's trying to pay down debt. What happens to the central bank's usual tools, like cutting interest rates?
This is the pushing on a string problem. It's an old idea, but very relevant. Meaning the central bank can cut rates, even to zero, but people and businesses might just be too scared to borrow.
Or maybe prices are falling, so cash seems better.
Right, deflation. Why borrow to spend if things will be cheaper tomorrow? The U.S. saw a lot of this from, say, 2008 to 2020. Monetary policy becomes less effective.
So then central banks start printing money. But that's not literal printing presses, is it?
Not usually, no.
Right.
In modern terms, it often means the central bank effectively borrows reserves from commercial banks.
Paying them interest on those reserves.
Correct. And then uses those reserves to buy assets, typically government bonds. They become the buyer of last resort.
Trying to keep things flowing. But that can lead to problems, too.
Oh, yeah. Potentially a really nasty situation, what Dalio calls a death spiral.
How does that work?
Well, imagine the central bank buys tons of government bonds when rates are low. Then rates go up. Now, the central bank might be paying more interest on the reserves it borrowed than it's earning on the bonds it holds. It starts losing money.
And its solution might be?
To print more money, to cover the losses and buy even more debt. It becomes a vicious cycle.
Leading to currency devaluation, inflation, maybe even a depression.
An inflationary recession or depression, yeah. It's a worst-case scenario, but it highlights the risks.
So these crises, they sound awful, but Dalio also sees opportunity.
He does. He points out that while they obviously carry huge risks, potentially destroying empires, even they also create massive opportunities for those who understand the dynamics and are positioned correctly.
So the big message seems to be, Look at the big picture.
Absolutely. Focus on these long-term big debt cycles. Don't get lost in the day-to-day market noise. That's how you miss the really important shifts.
Okay, let's get into the mechanics a bit more. You mentioned the difference between money and credit earlier.
Yeah, super important distinction. In our system, only the central bank creates actual money, base money.
And they can create a lot of it.
Theoretically, as much as they want. Credit, though, that's different. It's just an agreement, a promise to pay back money later.
And that promise changes things.
Big time. Credit gives you buying power now without new money necessarily being created. You spend more today.
But you have to spend less tomorrow to pay it back. Drives the cycles.
Precisely. It's borrowing from your future self, essentially. Amplifies the booms and busts.
And the central banks are pulling the strings here.
They have huge influence because debt is a promise to deliver money, and they control the amount of money.
So they influence credit availability spending.
Exactly. More money usually means easier credit, more spending, and vice versa.
Now, Dalio has this equation for prices. P equals total money.
Yeah, price equals total money spent divided by the total quantity of stuff sold.
How's that different from standard supply and demand?
It's more focused on the flow of spending relative to the quantity. Traditional supply-demand is more about, well, static levels. Dalio's view helps understand why people are spending or not spending, which drives price.
So it connects better to actual market behavior.
I think so, yeah. It helps you think about the motivations of the buyers and sellers and how much money they're actually throwing around, rather than just abstract curves on a graph.
And when I think about investments, storing wealth.
Dalio hammers this point. Look at real returns, inflation adjusted.
Not just the nominal number.
Right. What matters is your purchasing power. Are you actually getting richer in terms of what you can buy?
So investors are always comparing.
Constantly. They're looking at bonds versus equities versus real assets like property or gold, especially comparing government bond yields to inflation.
If bonds aren't keeping up with inflation.
People sell them. They look for things that might hold value better inflation hedges.
So when central banks are creating lots of money in credit,
it tends to push money towards those inflation hedge assets, things like gold, commodities, maybe certain types of stocks. Their prices often go up.
Okay, who are the main actors in these cycles? Dalio lists 5.
Yep. You've got your borrower debtors, could be anyone, people, companies, governments.
Then the lender creditors providing the cash.
Right. Then the crucial intermediaries, mostly banks, connecting the two.
And finally,
central governments and central banks, each with their own role and often their own motivations.
And the whole system has natural limits, right? Things that just can't go on forever.
Absolutely.
Well,
long-term debt just cannot consistently rise faster than the income available to service it. That's fundamental.
and interest rates can't be permanently sky high or rock bottom either.
Nope. Either extreme creates huge distortions and eventually breaks the system. It leads to crises when the IOUs get way out of whack with the real economy.
Let's put some numbers on this. Dalio has rules of thumb for debt sustainability.
Yeah, these are really useful. The key one is if nominal interest rates equal nominal income growth and there's no primary deficit.
Meaning government spending matches revenue before interest payments.
Right. Then the debt-to-income ratio stays stable. Doesn't get worse.
But the problem kicks in when interest rates are higher than income growth.
Exactly. That's when the existing debt starts to snowball. Even if you don't borrow anymore, compounding works against you.
And his example is pretty stark. A 2% gap.
Leads to a 50% jump in the debt-to-income ratio over 20 years. It shows how damaging that gap can be, especially if you start with a lot of debt.
He also stresses using debt to income, not debt to GDP, for governance.
Yeah, because what matters for paying the bills is the cash coming in, revenue, versus the cash going out, debt service. GDP is a broader measure, but income is more direct for solvency.
He uses tables to show this impact, right? Starting debt levels, deficits.
He does. They really hammer home how quickly debt ratios can explode if you start high and keep running deficits. Just look at the 10-year projections.
And then the tables showing the impact of interest rates being higher than growth.
Using CBO projections for the U.S., where rates are actually projected below growth slightly.
Minus 0.4%, I think.
Right. He shows how, even with that slightly favorable assumption, different starting debt levels still lead to wildly different outcomes after 10 years if rates were consistently higher. It highlights the sensitivity.
And this simplified toy model he uses.
It's a great illustration of that potential debt spiral. Rising rates, maturing debt. It shows how quickly interest payments can just swallow everything up.
Making the debt totally unsustainable.
Exactly. And it gets worse if you then need to borrow more, say for a war or a recession. It feeds on itself.
He gives a formula, too, for projecting future debt relative to revenue.
Yeah, it incorporates current debt, future spending, interest rates, growth. It's a way to estimate the trajectory.
And he uses it to figure out what it would take to stabilize U.S. debt,
He does. And the options are tough.
like interest rates down to 1%, or growth at 6.5% nominal.
Or government revenue up by 11%. Yeah, none of those are easy buttons to push. Each has major potential downsides. No simple fix.
Okay, let's walk through the typical path, the sequence that leads to countries going broke. Dalio uses these charts with different colored lines.
Right, so just quickly, blue is the average of all cases he studied. Red is specifically for countries with fixed exchange rates, pegged currencies.
And green is for fiat currencies, like most have today, or flexible rates.
Exactly. Helps to see the different dynamics.
And he notes this historical back and forth between hard money and fiat money systems.
Yeah, because both extremes tend to fail eventually. Hard systems break when the government runs out of the asset backing the currency.
And fiat systems break when people lose faith in the debt and the currency itself.
Precisely. It oscillates.
So the road to ruin often starts with big current account deficits, spending more abroad than you earn.
That's a classic early warning sign. Funding that gap by borrowing from foreigners builds up external debt.
Makes you vulnerable if they pull their money out.
Hugely vulnerable. The charts show this pattern clearly. Big deficits, lots of foreign buying of debt right before the crisis hits.
And by the time a devaluation looms,
The country usually has very little ready cash, liquid assets compared to what it owes foreigners.
the cupboards are bare, basically.
Pretty much. The charts on the net international investment position and liquid assets versus external debt paint a grim picture at that point.
And these governments are usually already on an unsustainable debt path.
Yeah, the projections at the time of devaluation typically show debt just going up forever and interest costs eating up more and more of the tax revenue. It's clearly broken.
Do they try things to delay the inevitable?
Oh, sure. They try liability management, restructuring debt. They call in favors from friendly countries or institutions.
Geopolitical deals for financing.
Yep. Maybe shorten debt maturities to attract buyers or slap on capital controls as a last resort to stop money fleeing, plugging the leaks.
But often it's not enough, especially if reserves are low.
Right. If the central bank doesn't have enough foreign currency reserves relative to its own liabilities, its ability to defend the currency is shot.
Which just encourages more people to bet against it.
Exactly. Leads to capital flight. Everyone rushes for the exits. The charts on reserves versus money supply show how low they often get before the run really starts.
And when the central bank does try to defend the currency,
They burn through reserves incredibly fast. The data shows they often spend over half their reserves in just 6 months.
wow. And it often fails anyway.
Frequently. And then the prospect of having no reserves becomes even scarier than just letting the currency fall.
Yeah.
That median 49% drop in reserves during intervention is telling.
How do regular people and businesses react in these situations?
Predictably, depositors get nervous, pull cash from banks, wealthy people shift money abroad, foreign companies get their cash out,
New investment stops.
paused indefinitely. Too risky. It's a massive vote of no confidence.
And the banks,
Yeah.
local and international.
Domestic banks might be forced to sell the government bonds they hold, adding pressure. Central bank policies can sometimes even incentivize them to keep money offshore.
And international banks.
They pull back, close risky lines of business, cut credit. Risk reduction becomes paramount.
What about quantitative easing, QE? When central banks hold lots of government bonds, Dalio sees risks there too.
He stresses that the central bank holding those bonds faces the same market risks as anyone else.
But they can print money to cover losses.
That's the key difference, yes. It masks the immediate problem. But if rates rise and they start losing money on those bonds, it can still lead to that negative net worth situation, technically. It undermines confidence long term.
And the type of assets the central bank holds matters too.
Absolutely. During a crisis, they often shift from holding hard assets, gold, foreign currency, to holding soft assets, like claims on their own government or banks.
Which weakens their ability to defend the currency.
Especially if they're trying to maintain a peg. Investors see those hard reserves dwindling and get nervous. Fuels the fire.
What about asset returns during these meltdowns? Devaluations, debt write-downs.
History shows a clear pattern. Gold and commodities tend to do very well in local currency terms. They act as a hedge.
And nominal bonds.
tend to do poorly, often delivering negative real returns. Gold often shines as that safe haven.
What happens to government spending and debt after the crisis hits?
Often there's an initial surge in spending, maybe not immediately financed by printing, but eventually.
The central bank steps in to monetize the debt,
Usually, yes, the charts show debt levels spiking and then the ratio of government debt to the money supply rising as monetization kicks in.
and the country's foreign reserves.
They typically fall relative to government debt during the crisis as the central bank defends the currency and debt rises. But after devaluation, that ratio often improves, partly because the debt is worth less in foreign currency terms.
But overall, government debt usually stays high as a percentage of the economy.
It tends to, yeah, it might come down a bit due to central bank buying, inflation, maybe some growth, maybe asset sales or defaults, but it rarely snaps back to pre-crisis levels quickly. The attribution chart breaks down why it changes.
And the government's interest costs.
Typically rise sharply into the crisis as a share of revenue, then eventually drift down afterwards.
And just to remind ourselves, these are the shorter cycles.
Averaging maybe 6 years or so, yeah. But they're all part of those much longer, multi-decade big debt cycles.
Okay, let's zoom out to the really big picture. Dalio's overall big cycle. He brings in 5 big forces.
Yeah, this framework is really powerful. He argues the major shifts in history are driven by the interplay of these 5.
Yeah.
1, the debt, credit, money, economic dynamic we've been talking about. Internal order and disorder, think civil conflict, wealth gaps, political polarization within a country.
3.
International world order and disorder shifts in global power, international wars, acts of nature, pandemics, climate change, things like that.
In fact.
Technology, human inventiveness, new technologies changing everything.
And he goes into these much deeper in his Changing World Order book.
He does. He argues that understanding how these 5 forces interact is key to understanding where we are now and where we might be heading.
And his take is that we're likely in a turbulent phase.
Very likely, yes. He sees the current interactions between these forces leading to potentially big changes in the world order.
These big shifts in order are driven by power changes, right?
Exactly. When rising powers gain enough strength to challenge the existing powers, that's when you get conflict, especially if the balance of power isn't clear.
And he brings up that old saying about power.
Power corrupts, and absolute power corrupts, absolutely. Something to keep in mind as power shifts happen.
He also notes that democracies themselves can change internally.
It's an interesting observation. Historically, countries can shift from democratic towards more autocratic systems, sometimes even within the existing rules, over just a few years.
And leaders in those periods tend to become
More nationalistic, militaristic, expansionist, autocratic. He cites figures like Caesar, Napoleon, Hitler as examples of that pattern.
technology. Human inventiveness is a massive factor too.
Huge. Think about AI right now. New tech changes living standards. Who has power? How wars are fought?
But it can also create bubbles.
Absolutely. Especially when fueled by unsustainable credit. Think the railway boom, the dot-com bubble. Innovation isn't always smooth progress. It creates its own cycles and risks.
So to grasp the big historical sweep, focus on the big events.
Right, don't get lost in the noise. Understand the major shifts and their underlying causes. Everything happens for reasons.
Okay, quick spin through the big debt cycle from 1945 onwards. How does Dalio frame this post-war period?
Within that big debt cycle context, interacting with the other 4 forces, and he stresses that the unexpected often happens at the extremes of these cycles. That's why understanding fundamentals is vital.
He highlights the real interest rate again.
Yeah, the inflation-adjusted rate. He sees it as the most fundamental rate, showing whether it's better to borrow or lend. Historically around 2%, he thinks. Big deviations drive the cycle.
And the yield curve, short versus long rates.
He looks at that too, usually slopes up. He shares his personal view that Fed policy has been maybe too volatile, too extreme. Prefers stability around that 2% real rate target.
What about the post-WWII money system, Bretton Woods?
Establish the U.S. dollar as the world's reserve currency, set against the backdrop of U.S.-Soviet competition. The U.K., heavily indebted, saw devaluations a classic sign.
And he noted that even huge events sometimes didn't rattle markets long-term.
Like the Cuban Missile Crisis, JFK's assassination, short-term blips. What really moves markets, he realized, are things hitting investment cash flows. Though, he adds, some conflicts do have lasting impacts, especially if leaders don't back down.
The China-Soviet relationship shifted too.
Yeah, they went from allies to adversaries in the 60s. That opened the door for the U.S. and China to shift from enemies to, well, cautious partners later on. Small shifts, big ripples.
And what do governments do under monetary stress?
Often restrict the movement of good money, like gold when people are fleeing bad money. They're devaluing currency. Capital controls, essentially.
Which ultimately happened with Bretton Woods itself.
Exactly. The U.S. couldn't maintain the dollar-gold link, ran out of gold relative to claims. The system collapsed in 1971. He also mentions MP2 and MP3 later-stage monetary tools, more unconventional stuff central banks try when rates hit zero.
Right, let's move into that post-1971 world. 1971 to 2008, fiat money, interest rate-driven policy.
So the U.S. goes off gold. The Fed now has much more freedom to create money.
And what happened?
Big increase in money supply, big jump in inflation over that first decade, 71-81. Stocks went up nominally, but down in real terms. Gold soared.
Good for debtors, bad for creditors.
Very much so. If you held long treasuries, you lost a lot in real terms.
And this fiat system is what we have now.
Crucially, yes. It allows governments to potentially inflate away debt, confiscate wealth subtly. Dalio notes fiat systems aren't new. History offers lessons.
The charts for that 71-81 period show big swings in rates and inflation.
Big time. And the yield curve moved around a lot. Real bond yields were often very low, even negative. Incentivized borrowing.
Then the Latin American debt crisis in the 80s.
Classic case. Borrowing heavily in dollars, then struggling to repay. Led to devaluations, restructurings, high inflation, sometimes selling state assets or pegging to the dollar to try and stabilize.
The 90s felt different.
Yeah, disinflation, but also a lot of leveraging up. Led to the dot-com bubble eventually. There was a brief downturn. Fed eased rates.
And globalization was really taking off.
Especially in Asia. Massive growth, lower labor costs. China started moving towards the WTO, but that rapid growth also fueled debt bubbles.
Leading to the Asian financial crisis in 97-98.
Textbook crisis. Debt bubbles burst, currencies collapsed, social and political turmoil followed.
Okay, next phase. 2008 to 2020. Fiat money and debt monetization QE starts.
Charts show interest rates hitting zero around 2008, a new thing, and then boom, the Fed's balance sheet explodes as a percentage of GDP.
That's the money printing, the debt buying really kicking off.
Yep. In response to the 2008 crisis.
Which itself was a classic.
Private sector debt crisis, yeah. Housing bubble burst, spilled over to the government needing to bail things out.
And Europe had its own version.
The European sovereign debt crisis. Greece is the poster child. Government debt squeeze. Markets lose confidence, credit tightens, economy tanks, reserves fall.
Then austerity measures made it worse.
Led to an ugly deleveraging, as Dalio calls it, massive pain.
All right, brings us nearly up to date. Since 2020, pandemic, big deficits, lots of monetization.
Right. COVID hit, wealth gaps were large, politics shifted leftward in the U.S., resulted in huge government spending, massive deficit.
And central banks bought a lot of that new debt, MP3 territory.
Exactly. Credit became super cheap, super plentiful, fueled new bubbles. Dalio's bubble indicator hit 75% by end of 2020, similar to past peaks.
And low rates post-2008 had already boosted assets.
Massively. U.S. household financial wealth tripled from 09 to 24.
But then the Fed shifted gears.
Tightening. Yep. Rates started rising, nominal and real. Hurt asset prices, deflated those bubbles. Bubble indicator fell back.
We saw stocks and bonds fall in 2022.
We did. Dollar strengthened, hit weight-sensitive sectors.
And other forces were at play too.
Internal conflicts intensified, especially in the U.S. The 2024 election brought Trump back, signaling potential policy shifts, maybe more confrontation with China, climate change, AI advancements, all interacting. Dalio sees strong parallels to the 1930s again.
Let's switch focus to China's big cycle. How does Dalio sketch its history?
Briefly mentions the century of humiliation, 1839-1949, crucial context for understanding leadership perspectives.
And the debt chart shows big swings.
Huge swings. Debt builds up, gets wiped out by wars, new orders. Building stable credit markets was tough until the late 80s, early 90s.
Then Deng Xiaoping's reforms were key.
Massive turning point. Market focus, capital market development. Dalio is actually involved advising China then. Xi Jinping initially focused on reform too, anti-corruption.
Geopolitics played a role. Russia, Crimea.
Yeah, 2014 annexation pushed Russia and China closer despite historical mistrust. Xi's 2025 plan also raised alarms in the U.S.
Along with trade, assertiveness, IP issues.
Right, led to the current U.S.-China squaring off, as Dalio puts it, echoes of the 30s, trade wars.
Though Trump and Xi had a certain rapport.
Some level of direct engagement, yeah. Dalio notes the different cultural approaches to conflict, direct Western style versus more subtle strategic Chinese style like art of war.
How does China look against the five forces now?
Facing rising debt, internal political shifts, different from U.S., intensifying U.S. conflict, environmental issues, big tech push. Dalio mentions guiding principles like Détente, Confucianism, legalism, seeing the state as a family, different views on capitalism.
His conclusion on China's values versus capitalism.
Some similarities to Christian values, but different from extreme capitalism. Notes capitalism's effectiveness at wealth creation, but also its inherent cyclical instability.
Okay, let's talk Japan. What lessons can we learn there?
Starts with 1868, end of the shogunate, Meiji Restoration, modernizing along Western lines after foreign pressure.
And their recent debt story is interesting.
Very. Charts show government debt doubled since 2001, but publicly held debt only up about 30% of GDP.
Ah.
The Bank of Japan holds a massive chunk of it, kept long rates low, cut debt service costs.
But there's a risk there.
Big risk. Even a small rise in real rates could cause huge mark-to-market losses for the BOJ, could trigger deficits, debt spiral. Interestingly, though, worker earnings, cost of essentials in labor terms, pretty stable.
And we saw private debt fall as government debt rose.
Yeah. Illustrates Dalio's dynamic, too. Central bank monetizes debt, keeps rates low, trying to boost demand. So government debt minus BOJ holdings as percent of GDP actually fell.
Debt service costs in yen fell too.
Despite rising total debt, yes. Because of low rates, longer maturities, BOJ buying.
How does Japan's debt look in other currencies?
Measured in dollars or gold, it's actually down since 2001, deleveraging in foreign terms.
So Japan is the ultimate pushing on a string case.
Pretty much. Low nominal rates, slightly negative real rates, tons of QE, upward sloping yield curve, but still very low inflation. Comparing Japan's debt interest burden to other historical cases provides useful context.
All right, let's get to Dalio's bottom line on U.S. government debt risk.
Long term, he sees it as very high. Current and projected debt, debt service, rollover risk. He thinks it's near a point of no return, potential death spiral.
But short term.
Relatively low risk for now. Moderate growth inflation, low credit spreads, a healthy-ish private sector tax base, but warns that can change fast.
And the Fed's own risks.
Holds lots of government debt, highest losses ever recently, weaker net worth, long-term risk exists, could grow. Short-term, less worrying economy near equilibrium, no major inflation-deflation crisis yet, not actively monetizing heavily right now, dollar stable enough.
So he proposes this 3% three-part solution. What's the core idea?
Observation. Policymakers get lost in the weeds, cut this, tax that. They don't agree on the big picture goal first.
So he says, agree on the target first.
Yes, a top-down approach. Agree on the size of the cut needed as percent of GDP, and have a fallback plan if they can't agree on specifics like equal percentage cut hikes across the board.
And the target is 3% of GDP for the deficit.
Right. He thinks hitting that could significantly lower the debt trajectory over 10, 20 years. He also stresses the Fed, interest rates, has more impact on the deficit than Congress spending taxes.
So the solution involves all three levers.
A balanced approach, yeah. Roughly equal contribution to that 3% GDP deficit cut from spending cuts, 4% of GDP worth, tax hikes, 4% of GDP worth, and real interest rate cuts, 1%. Phase it in over 3 years. Use it as a bipartisan fallback.
And he gives specific examples of cuts in taxes.
Just samples to show it's possible. Things like limiting Medicaid transfers, raising retirement age, cutting some medical education payments, military personnel costs, rolling back IRA climate bids, capping non-defense spending growth, totaling maybe 1% of GDP.
Weigh in on the tax side.
Capping employer health insurance deduction, ending mortgage interest deduction, taxing veterans' disability, removing step-up basis on inheritance, axing education credits, maybe a 5% VAT ex necessities, 10% tariffs. Again, examples totaling around 1% of GDP.
The timing is crucial, though. Do it when the economy is strong.
Absolutely. Cut deficits counter-cyclically when the economy can handle it. Have supportive monetary policy alongside. He argues now, or when he wrote it, is a good time near full employment, moderate growth inflation, decent private sector shape.
Delaying makes it worse.
Much worse, because of those self-reinforcing debt dynamics. Gotta act proactively.
Okay, peering into the future, Dalio's crystal ball is cloudy, but
He emphasizes preparing for the unknown. His approach is cause and effect models, using expert systems to process tons of data.
he looks at the five forces again for the U.S. context.
Yeah, notes other G7 nations and China are in similar boats in many ways, adds demographics, aging, shrinking workforces, reiterates that excessive debt forces governments to break promises eventually.
Through printing money, restructuring debt, capital controls.
Exactly. Could see radical moves by leaders like FDR or Nixon did. Less likely now, maybe, but be aware. He advocates for a beautiful deleveraging, balancing the painful stuff, fiscal tightening, restructuring, with the inflationary stuff, monetary easing, monetization.
Sees an end to the era of borrowing for consumption.
Believe so. Future focus needs to be productivity, debt reduction, which also devalues existing debt money. Different sectors hit differently, expects debt service costs to keep rising due to the lag from rate hikes.
And questions about central bank independence.
Will the Fed be able to run policy for everyone? Expects more criticism, interference. Independence isn't guaranteed. Sees the current mix, high debt, internal-external conflict, climate, AI creating huge risks, but also opportunities, productivity, wealth creation. Worries about a debt squeeze downturn in 2-3 years.
What about the markets? He mentions popular memes.
Yeah, says there's always a popular story priced in, often wrong. Investors tend to be long, often leveraged.
And the current meme, early March 25.
General optimism. Good current conditions, AI hype, Trump's perceived business-friendly approach, working with Musk, American exceptionalism.
He sees merit, but thinks it's priced in.
Pretty much. Acknowledges U.S. strengths, innovation, capital markets, legal system, but warns the meme ignores deep problems, education, inequality, productivity gaps, thinks the debt issue will force monetary system changes one way or another. Holding debt becomes less attractive.
He also sees a global shift towards security over efficiency.
Yeah, resilience, onshoring, like wartime footing almost, increases indebtedness, country finances driving conflicts more, divides emerging markets, some surging, India, Indonesia, Gulf, others falling behind. Financially strong, orderly, neutral countries might do best. Global deal-making is increasing rapidly.
He shows data on U.S. political polarization increasing.
Long-term trends since 1790, plus recent surveys showing high conflict perception globally. Global polarization index near historical highs.
And this disorder impacts how power works.
Argues financial, political, military power trump laws in times of disorder. Authoritarianism can seem more effective. Sees Trump's approach as part of this competitive dynamic. Notes historical shifts from democracy to autocracy when people are dissatisfied.
New leaders consolidate power.
Often forcefully, increasing control over law, like executive orders. Predicts more fights between government branches levels clarifying power. Executive branch ultimately has enforcement edge.
But the system has to work for most people.
Fundamentally, yes. Points to deep U.S. problems, education, family, social issues leading to many being net costs. Sees Trump admin trying to boost productivity by empowering the most productive. Says watch the bottom 60% well-being closely.
And the U.S.-China conflict is intensifying.
Big time.
Yeah.
Compares it to the 1930s. Domestic and international implications. Alliances hardening. Shows data on relative U.S. power decline, rising conflict intensity, Thucydides trap dynamic.
Current state is conflict short of war.
Yeah, Trump and Xi negotiating directly. Both want to avoid war, but eliminate the other as a threat. Suggests a decisive win might need a secret superweapon, a tech breakthrough.
And AI isn't the only key tech.
Nope. Quantum, biotech, robotics, space, U.S. and China are key players in all.
But he is optimistic about innovation potential.
Very. Combining inventive people, capital, including AI, right environment could yield revolutionary gains. But tech is double-edged, enhances good and bad. Shows graphs of accelerating GDP life expectancy due to knowledge growth, expects AI to continue that.
Yet tech alone might not be enough near term.
Based on history, he thinks the headwinds from the other forces might be too strong in the next few years for tech to overcome completely.
Ultimately, it comes down to how people treat each other.
That's his bottom line. Shared problem solving is key. Mentions the possibility of good leadership managing debt well, like U.S. hitting 3% deficit cut. Ends with that principle. If you're not worried, you need to worry. And if you're worried, you don't need to worry. Meaning preparedness is everything.
Okay, so summing up this deep dive into Dalio on how countries go broke.
We've really covered the cyclical nature of debt, the typical crisis stages, how those big five global forces interact.
Looked at historical cases and his views on where we are and might be headed.
And hopefully understanding these mechanics, these patterns, gives you a valuable framework for navigating what's happening.
Yeah, making sense of a complex world.
Exactly.
So a final thought to leave you with. As tech, like AI, keeps accelerating and the world order shifts, how will these debt dynamics and the five forces collide to shape our economic and geopolitical future? Something to chew on.
Definitely. And if you want more, really do check out Dalio's work. Economicprinciples.org has a ton of resources. It's worth the deeper dive.
Absolutely. Thanks so much for joining us for this deep dive.